Hello everyone, I'm Anita, Assistant Professor at Department of Commerce. Today we're going to see about the subject is financial management. The topic is net income. Let's see the topic is what is the understanding of net income approach? The clear guide of how the financial decisions impact company value through the loan of the income and capital structure. This is the net income. And then we see the what is net income. Net income represent the profit remaining after all the expenses, taxes and cost of total revenue. It commonly called the bottom line because the appears at the end of an income statement. Let's see the diagram. The revenue minus expenses equal to net income. This is the main thing. There is have a 3 steps also. The revenue, expenses, and you get the net income. Next we see the net income approach in finance. How it is working in the financial sector. There is have a 2 things. Core principles, and the second one is the theories. The core principle is nothing but using more debt which typically cost less than equity can increase the firm's total value by lowering the weighted average cost of capital. The theory, since debt financing is then the equity leverages a debt, reduce overall capital cost and boosting fair valuation. This is the second one. Next we see the why debt can increase frame value. How it is increasing the value. There is have a few things to increase the value of the company. First one is a lower cost of debt. The second one is reducing capital cost. Second one is we already seen. The third one is higher net income. The fourth one is increased frame value. Let's see one by one deeply. The lower cost of debt is nothing but debt insured payments are typically the return value of the money equity investors make borrowing an attractive financial option. The second one is the expensive equity is the captor debt. The company lower its overall weighted average cost of capital. The third one is lower financial expenses means more profit remains after covering all cost directly insured net income. The fourth one is increased firm value. While reduced capital cost, the frame valuation rise, all investors pay more of the same in earnings streams. Next we see the importance of the net income approach. What are the main importance in the net income approach? Let's see one by one. Constrained capital cost. Second one is no risk. The third one is ignore market realization. These 3 is the main thing in the importance of net income approach. Next we see the how the calculate frame value using net income approach. There is have a small formula for this. Frame value equal to net income divided by cost of capital. This is the formula for applying the net income approach. Next we see the real world limitations of this net income approach. The net income approach simplify several criteria factors while affecting actual business decisions. Um, that is cover a few listed things. First one is expenses dips determine the increasing the profitability of the financial distress in the. Next one is investors risk premium. Leverages increase investors premium in the high risk and the low demand in the business. Next one is tax and transaction cost. The tax and transaction cost is nothing but what are the process and the official transactions and limitations will be included in this. The real world factors like tax, benefits of debts, issuance cost, these are all included in this. Thank you.